Recent warnings from the OECD are that debt levels are becoming unsustainable, with corporate debt now more than double the levels that were before the financial crisis. More and more people are asking, where is their protection? Well, one area, of course, is precious metals. Simon Popple joins us now from Brookfield Capital. Simon, welcome. Yeah. We've spoken to you a lot before about gold and the protection that this particular part of the market offers. But I want to get a sense from you as to where we are and how you're feeling about where we are in the context of the OECD, amongst other things.
Well, I think there's a lot of sort of black swans out there, a lot of things that people are nervous about. And no one really knows what's going to happen. You know, we live in interesting times, potentially challenging times. And if you look at sort of the various asset classes out there, equities, bonds, real estate, they're all at pretty much all-time highs, or certainly they're viewed as expensive. And so if you look at gold and how gold has performed when we've had market downturns, it's actually done pretty well. You know, first of all, in the 70s, you know, 1970, 78, you know, you can see that you know, when the Dow went down, gold performed pretty robustly, and then again in the 1980s, when you had the stock market crash in 1987, the COMEX gold did pretty well. And you know, for people with sort of shorter memories, when we had the crash in 2008, again, gold did pretty well. So on the one hand, you know, yes, people like to make money, but I think gold is also, it has the potential for a good sort of protector of the money you've already got. So I think that's an area that people are perhaps, you know, getting more interested in.
I think one thing is good to mention. I think one thing that's good to mention out of this is the fact that gold is based in dollars. So the charts you've just shown are, of course, the dollar-based gold. But in fact, I noticed actually for purchases in sterling, gold is performing better.
It is, you know, and also in Australian dollars. You know, we're talking about all-time highs. So Brexit is a sort of, I know, a dirty word at the moment, but if you're particularly worried about, let's say, the pound, then having an allocation of your capital in gold could well help you, you know, retain your purchasing power should sterling, you know, suffer as a result of Brexit.
But there is a risk warning to this, of course, isn't there, about the risks in holding gold?
No, absolutely. It's a volatile sort of asset, like all assets are volatile. But I think, you know, what I like about gold is it's been around for thousands of years. You can't print it, and it's tangible, and it's recognised all over the world. And I don't think there's many assets which have that sort of global recognition, you know, like gold does.
What about the risks of not holding gold at this particular part of the cycle?
Well, personally, I think there's greater risks to not holding gold than holding gold, really, because, as I say, it's you either hold it as a tangible asset in terms of, you know, you can get coins, Britannias, which should be capital gains tax free, or you can get into the mining shares. And I think it just gives people a reassurance, perhaps, if they've got an allocation of their capital in something that is you know, physical and you know, to an extent, asset-backed.
Let's take a look at the really long-term picture for gold. I know you've got another chart which shows it's going back many, many decades. What about gold and where we are? Because we think of gold as what, about $1,300 an ounce at the moment. It's been higher than this, but of course we know it's been a lot lower as well. In the context of the really long-term picture, we're quite high up the chart.
Well, sort of yes and no. I mean, if you compare the current bull market, and you know, let's be realistic here, we are in a bull market for gold if you look at what's happened since 2000. If it was to replicate what happened in the 1970s, even though it's gone up, there could be a long way to go. And it's, you know, no one really knows, and if it did happen and you hold gold, you can make an awful lot of money. But I don't think it's necessarily about making money. I think it's about protecting money. And I think that people, you know, if they want to get into mining shares or have an allocation to mining shares, yes, you know, they could do phenomenally well. But it may be that people just want to say, well, let's stick with what we've got and allocate a proportion of our portfolio into some form of gold asset.
What are you doing at Brookfield Capital?
Well, I mean, I write a newsletter, the Brookfield Capital newsletter, which is really giving people some ideas and trying to educate people about the gold market and give them some ideas about mining stocks and investing in gold and silver. And I think that, you know, if you look at how much people have allocated to the sector, I think there's huge ignorance about the asset class, and people just need to become perhaps more aware of it.
Personally, are you fully invested in this end of the market at the moment, or are you holding a bit back in case there's another opportunity to buy in?
I think it's always smart to hold an element back in cash, but then you've got to decide what cash you want to hold, because, you know, some people have gone to cash, they've gone to sterling, and just watch the sterling depreciate against other asset classes. So you do need to be a bit careful, but I like Australian dollars and Canadian dollars because so many mining stocks are denominated in those currencies, so it just makes life a little bit easier when you're trading.
Okay, all right, Simon, thanks for putting it all into context. It's good to talk to you again, and thanks for dropping by. Simon Popple, Managing Director at Brookfield Capital. If you want to find out more from Simon, just join him on his website.